Okay, good morning everybody and welcome to the latest monthly update for Retire Invest Newcastle and Lower Hunter. It's been a few weeks since we spoke to you last time, and obviously a lot of things have changed with the Victorian outbreak going ahead, and now we're moving into pretty much election season in the US. So we've got some things to talk about in terms of how we think the news cycle and the markets are going to look going forward. So without further ado, I'll get into this. You can possibly see on the screen with me today, Paul Guttridge. Paul's an old friend of mine that very experienced advisors come to work with us. I'll introduce Paul in just a moment. So as usual, we'll have a quick look at what the markets have done for the last few weeks. Then we'll get into some interpretation and some opinion on where the markets and the world is headed over the next few months. Take questions at the end if anyone wants to ask via the chat icon. So today's session should be under 30 minutes. We've rehearsed it already. Please ask any questions via the chat icon. You're muted on the microphone. If you have any difficulty with sound, try turning your video off, and the session will be recorded and made available to you afterwards via our website and our YouTube channel. As always, if you'd like a copy of any of the slides or like to talk to us, please reach out to us via the chat icon or call us afterwards. Okay, so Paul Guttridge has come to join us. Paul's a very experienced advisor, been part of the industry now for 18 years, initially as an accountant and latterly as a certified financial planner. So Paul has become a senior financial planner with our team and is bringing a lot of experience and a lot of wisdom to us. We're very much pleased to welcome Paul. Paul's very much one of us. It's quite interesting in this world, the different views people have on what financial planners are. To us, it's actually it's more than just an investment discussion. It's a human discussion, and Paul's very passionate about people and making sure that the right outcomes are achieved for them. Family man, Paul lives in Maitland with his wife Sarah and daughter Laura. Paul's very much into outdoors, triathlons, cycling and caravanning. So when you get a chance, welcome Paul. If you run into him or he comes across you, trust me, Paul's very much one of the family already, and I think you'll find him pleasant company, if, of course, to be dealing with him. So without further ado, I'll hand over to Paul for the market update. And Paul, I'm just going to pause the recording.
Thanks, Gil, and thanks for that introduction as well. And it's great to be part of the team. Like Gil said, hopefully I'll get to meet some of you along the way. So yeah, really looking forward to the time in RI, Maitland and Kataro. So, but anyway, we'll go on with the market update. And I guess I'll talk about the elephant in the room, which we're all hearing about day in, day out, which is COVID-19. And I guess the main focus at the moment is Victoria, which we've seen a lot of cases, increased cases in the last few weeks from Victoria, as you can see from that graph there. You'll notice on the red there, where the Victorian cases have increased over the last month or so, which is quite concerning. Hence why Victoria have started to lock down, and they're at stage 4 across the states. So. And that's why they're concerned about that. The potential outcome of that is potentially knocking off about $12 billion off the Victorian and the national economy, which is a bit scary for a lot of people and obviously the markets. So yeah, perspective though, if we just put it all in perspective, because obviously the media like to beat it up a little bit. In Victoria the other day, we had 322 cases, new cases, whereas compared to, say, America, where there was about 50,000 new cases. So it just gives you a bit of an idea on the scale of things. And I guess what Victoria are trying to do and Australia are trying to do is be pretty strict on their lockdowns. I guess they're trying to follow New Zealand, which on Sunday, they just reached 100 days without any transmission. Although overnight that changed a little bit. They had 4 new cases overnight in Auckland. So Auckland have increased their lockdown to stage 3, whereas the rest of New Zealand is at stage 2. So, but yeah, Victoria trying to follow suit with that and lock it down so we don't have many more cases, and obviously, as you can see there on the screen with the chart in terms of deaths, and that's in deaths per population. So just to give you a bit of an idea, once again, putting in perspective, New Zealand, Australia, way down the bottom there in terms of deaths per million. Whereas you can see America, it's at 488 cases per million. But I guess the most concerning part is Europe, where we've got Sweden, UK and Belgium there being the highest cases per million in terms of population. So and I guess that's because they're pretty condensed in Europe as opposed to USA, and even Australia and New Zealand were a bit more sparse. So pretty concerning. I guess that's the markets been a bit contradictive of what the negative impact this COVID-19 is having, and the market's been pretty buoyant in a way as we go to the next slide. So, for example, the Australian market, even with Victoria being locked down stage 4, the markets have reacted fairly positively, as we can see by the green there. Now, you don't have to worry too much about the numbers, but basically over the last month, since we last had an update from it's increased by about 2%. And to give you an even better idea, the American market has increased by about 3% over the last month as well. So, and generally Australia follows the American markets. So it just goes to show that the markets have kind of already factored in the COVID-19, and as long as COVID-19 doesn't get too bad across the world, then the market should continue to be volatile, and but heading in the right direction, heading north. So that's a good sign. Other things to keep in mind for the Australian economy and markets is the cash rates, which the RBA left the cash rate at 0.25 last week on Tuesday, so they haven't really got too much room to go down further to help stimulate the economy. Look, my prediction is they might reduce it later in the year down to about 0.1, but I suspect they'll try and avoid going naught or negative percentage rate. So hopefully it doesn't. Hopefully it stays there, and I think a big factor, or a couple of big factors in that, in terms of unemployment, how the unemployment rate's going, and also how the property market's going as well. So if we do see the property prices start to decline, that's when they might potentially reduce the cash rates. Another factor which is big impact is the Australian dollar. I don't know if anyone remembers, most people haven't because they're not travelling, so they're not exchanging Australian dollars with US dollars. But back in February, the Australian dollar was equal to 0.55 US dollars. Okay, so there's been a fair rally in the Australian dollar over the last, 5 months, since we've started recovering from the COVID. Couple of reasons for that. Federal Reserve is printing more money than the Australian government or RBA, so that obviously devalues the US dollars because there's more dollars out there compared to the Australian dollar. It's a bit more precious, so it's holding its own. Another reason for that is the optimism. So we believe the Australian markets will probably recover a little bit quicker than, say, the American markets and European markets, even though the American markets has improved quite well over the last month or so. Commodity prices have been increasing, as well as China's demand for our iron ore. So another reason why the Australian dollar has been holding pretty well. Overseas, what's happening overseas? We generally look at the S&P 500, which is like the top 500 companies in America. The S&P 500 has been moving higher and higher, which has been good, even though and that's probably because of the potential of the COVID-19 vaccine. There's lots of companies out there that are trying to do their research and potentially coming up with some sort of vaccine. So there's hope that that'll happen. I still think we're a little way off that yet, because they've got to do a lot of testing to make sure this vaccine is going to work on the human population. So unlike, I think, Russia, they've come up with one and they're potentially going to be putting it out to the population. So which I think is a bit concerning. When from what I can hear, they haven't done thorough testing as they should be under normal circumstances when trying to find a vaccine. Obviously, there's a bit of fiscal and monetary stimulus coming out through the Fed printing money and those sorts of things as well. And also better than expected earnings in some of the companies. So they're either making better profits or the losses aren't as bad as first predicted, so, which is good. Another reason I think the markets are doing fairly well is because of the NASDAQ, which is our tech stocks. So a lot of the top tech stocks there, and as you can see there, what we call the FAME stocks, which is the Facebook, Amazon, and Apple, and Network, and Google, and all those big companies we've all heard of. They're really driving the American market. So how I see it, it's the tech stock index is kind of like in Australia, we've always known the banks to do well and have been a solid part of the Australian market. Well, I believe the tech part of American market is becoming that solid piece in the American market. And of course, everyone's doing Google searches, a lot of people are streaming, etc., etc. Social media is pretty big, so those companies are just innovative. They're really producing more products all the time and really trying to grow their business, and that's where a lot of the profits and as a result, the American market does fairly well. So, and that's really been the stronghold, especially over the last week. It's most of those stocks have been hitting records. Especially last week, they hit a record every day last week. So yeah, that's why the American market's going so well. Elsewhere, China, like I mentioned before, Australia's doing well because of the Chinese economy. It's going from strength to strength. It's not like it's got over the COVID. There's still little pockets here, there, and everywhere COVID is springing up, but they've got over the main part of the COVID-19 concerns. So therefore their economy is getting back to normal and starting to grow a fair bit more. And of course, what does that mean? That means their demand is a bit higher for our raw materials. So not only that, I think that's the other reason why there's a lot of optimism around Australia economy is recovering quicker, because of that Chinese economy has recovered. And of course they rely a bit on our raw materials. So what's the response from, let's say, the Australian government? I'll focus on that. Economic response. Well, we've all seen what stimuluses they brought out. One of the main ones that's changed recently is the JobKeeper payment, which has actually been extended to 28th of March. That was meant to end in September, but they've actually extended it to 28th of March, which is a good sign for employers and employees as well. So to try and keep the economy going along, especially in Victoria. So it's become easier for employers to access it, and because of the various rules there, and I won't get into that. It's pretty technical, and it just makes it a bit easier for those companies to get access to that, which means they're able to keep their employees on the books for a bit longer. So hopefully that's the case, and that'll continue. A few other things that the payment rates they're going to change in the future. So there's going to be two dates there that will change, and all that's about is how much they actually pay the employer to pass on to the employee. And they've also put in a two-piece factor in that as well. So in other words, instead of just a flat $1,500 per fortnight to every employee, they've broken it up depending on how many hours you work. And the reason they've done that, well, a couple of reasons they've done that. One, it's costing the government a fair bit of money, and they can't keep going paying the $1,500 per fortnight. And also it seemed a bit unfair if someone was working only about 10 hours, only getting paid, a couple of $100 a week or $400 per fortnight, or why are they getting the extra money there? So they've sort of broken it up depending on how many hours you work each week. So that's why they've done that. So yeah, One of the other things I always mention as well is just where you get your information from. I've got that information from the Treasury. So if you're ever wondering or just want to confirm or not sure what the media have said, probably a good place to go to the Treasury government website on any of the stimulus measures that the government's brought in, rather than relying on the media. So, yeah, just my little tip for there. So don't rely on the media. They like to beat it up a fair bit. Obviously, they're going to make some money. So that's how their way of doing it. So, yeah, so always rely on the government sources. And that's it for me, Gil. So I'll hand over to you now. Oops, your microphone's muted there, Gil.
Thanks very much, Paul. I'm just going to share my screen now. If you can just bear with me just for a second, folks. I think you've now got my screen there, Paul.
Stopped yours. I stopped mine. You should have yours now.
So there's your slides that you've just been through. So I'll jump over that. So, yeah, things keep going on, guys. And we know that the next year or two is going to be interesting and colourful. The American election and the reporting season coming up is going to make for a lot of news in the media. As always, you need to colour what the media says to fully support Paul's argument there that the media is more interested in the headline than the truth. What I'm going to do now is get into, again, some data on what's actually going on out there. So one of the things I've spoken about before is the value of steel in terms of the world economy, and specifically in terms of the Chinese economy. So what we're seeing here is from the moment that COVID-19 became a thing, the iron ore price that initially fell from $84 a tonne, it's now up to 120, which is an indicator, or if you remember the figures I gave you a few weeks ago, 56% of all Chinese exports contain steel and 62% of all Chinese iron ore imports come from Australia. The next biggest factor is Brazil, which is 21%, but Brazil's a complete mess. So the demand for iron ore all around the world has been improved by China needing to spend money and build infrastructure, and by the supply of iron ore shrinking. So that's very good for the West Australian economy, which is part of our economy, I guess. Another factor which you'll recall me talking about some months ago was the iron ore price. Now, if you remember what happened, the Russians and the Arabs got together and decided to not reduce the amount of oil being produced, and as a result, the oil price went down. At the same time as the supply and demand, so the demand for oil decreased when the COVID-19 thing happened, resulting at one point in a negative oil price, which was really just to do with the fact that all the world's refineries were full and that no one wanted to buy any more oil that particular week. Now, the critical thing in terms of the markets and the world economies is the oil price as it meets the US manufacturing costs. And the US shale oil suppliers need the price to be at about $40 a barrel, just so that they can break even and keep alive. So it pleases me no end that from the middle of April through till about the start of June, the oil price climbed back to where it needed to be, which is around that $40 a barrel. Now that's very good for the US bond market. I won't get into the details, but the US bond market is where the US companies drive or gather a lot of capital to run their businesses. And in this instance, the bond market is looking quite strong. Because the US government's been buying it and the oil price is where it needs to be. So that's a really positive sign in the context of the world's biggest economy. Now, what I want to do is have a quick look at some of the purchasing managers' indices. Now, the government, as you know, is willing to do anything to stimulate the economy. It's printing money, it's doing everything it can, handing it out to people to keep the economy ticking over. So in this world, there are three suppliers of inputs to the world economy: government, business, and labour. So the government is printing money, it's giving money to labour so that people will spend money. These next series of graphs explain what business is thinking. Now, the Purchasing Managers Index is essentially the accountants telling you what they're planning on spending over the next 6 or 12 months. And this one's the Caixin GM Purchase Manager Index. It's essentially the Chinese summary of business intent, and anything above 50 is viewed as a very positive thing. So we can see now that the actual index is as high as it's been pretty much in the last 10 years in China, which explains why the iron ore price is going through the roof, because Chinese businesses are planning on growing their spending and their output. Now, this is a very good result. It plummeted there very quickly, but the government stepped in, and all of a sudden the businesses are now looking very optimistic. If we look at the same indice in the US, the Purchasing Managers Index, above 50 is good, right? It has been higher in the US at around about 60, but if we go back over the last 25 years or so, it's clear that we're actually on the upside of average, but quite a long way on the upside of average. Now, again, what this is saying is that American corporate world is planning on spending money. Above 50 is good. It's comfortably above 50. It took a dip there for a little while, but it's looking very strong here. Now, if we look again at Australia in Eurozone, again, they took a dip. It's now above 50. So European countries and European companies are planning on increasing their spend. And that's a positive sign. If we look here in Australia, again, the Australian PMI index is above 50. Yes, it's taken a wobble. Yes, it's still not as high as it has been in the past, but right here and now, it's above the break-even line of 50, and it's looking like the Australian economy and the business side of the Australian economy has the intent of spending money to make things go well. Now, it's not that we don't have negative sentiment out there. Of course we do. We've got the media telling us about it every day. We've got the banks being concerned about property. We've got a lot of people whose income is under threat. So I find with a lot of our clients that they're healthy, they're happy, they're not going out, they're not spending their money. Once the vaccines start to come on, once the mood shifts and this problem with Victoria passes behind us, I think you're going to find a more positive vibe in the economy and the stock market again. So again, very positive number there for us. Now, another conversation I'm having with clients right now is, what about gold? Isn't gold where we should be? Is gold the thing, right? So I went and did a bit of digging. Right? Gold at the moment is as high as it's ever been, which is getting towards 1900, almost 1920 per ounce, which is at record highs, there's no question. So I went to the Perth Mint, which is an example. It's one of the places you can go and you can buy gold, right? And it's really interesting when you look at these figures. If you go and you buy a small bar or a small coin of gold, there's a buy and sell cost associated with getting into it. So if the Perth Mint wants to sell you a 1 gram bar of gold, they'll only buy it back to you for $86. It costs $104 to buy it. So the transaction cost in gold in this example is really quite expensive. It's 20%. For the coin, it's actually closer to 50. For a larger bar, it's 5%. And when you get into the larger amounts, the 1 kilo coins or the 1 kilo of gold bars, the transaction costs are 3% to 6% just to get in and out. Now, that's a really interesting perception when you look at what the history of gold has been over the last 25, 30 years. So gold has averaged since the early 90s 6.3% as a return, but it costs you 3 to 5% to get in. Now, if we're going to take a short-term step into gold in some sort of hopeful attempt at trying to anticipate where the market's going to go, you're going to get this sort of experience where it can go up, and it does go up, but also goes down. You also lose money. There's nothing unusual about a 10% decline in the gold price, as is there nothing unusual about a 10 or a 20% increase in the gold price. But the average return over that period is 6.3%. Now, I want you to contrast that with the average return from the Australian stock market over that period, with one exception. In the last 30 years, essentially 28 years, the Australian share market has been the more consistent place to be. Now, that exception was 2008, the global financial crisis. It was fairly short and sharp, but it was there. Certainly the average, though, for the growth assets is the Australian share market. And you'll know if you've been watching these videos that at least 50%, if not 70% of the return you get out of the Australian share market is in fact the income that the share market provides. These are dividends. If you look at gold, there is no income. There is only transaction cost to get in and out, and then any growth in the gold price. So it's not that the gold's not an option right now, but it's very difficult to get in and out of. And it's also quite a volatile asset by comparison to the share market, which is an interesting statement because the share market is often held to be one of the more volatile places to put your money. So I hope you understand why it's not easy for us to get people into gold, nor is it a particularly safe or predictable asset class to be in. So you have some exposure to it in your portfolios because we've got gold stocks in your portfolios and they do very well off the back here. But it's not an easy thing to buy gold specifically. Now, there's another thing that's going on right now. You may have heard of this gentleman. His name's Donald Trump. And he's got a friend named Joe Biden. And they are running for re-election in the USA right now. So where are we now? We're in August. So the election will happen in November. So what I did is to go back and look at the history of the stock market response over the last 100 years, and see what happens in years where the US election period happens. Now, there are some negatives, not many, but curious enough, when you look at the negatives, such as 2008, it was a bad year, but it wasn't a bad year because of the election. It was actually a bad year because it was 2008. If you go back to the other fairly negative event, you'll see it happen in the 1930s and 1940s. 1930s was the middle of the Great Depression when there was all sorts of financial mismanagement going on. And I refer you back to the videos from about 3 months ago where we had a good deep dive into the Depression and why what happened there is very different to what's going on now. Right? And then in 1940 is basically in the middle of World War II. So again, a negative period. So with some confidence, you can strip those out and say that the negative result is a function of the strange events that were going on at that period rather than the election itself. So if we look now at the history of American elections, you can see that with very strong consistency, the optimism surrounding a strong government and a strong outcome for that government tends to encourage the markets to be very positive. And this will have a knock-on effect all over the world. So again, just to go back to the last presentation we gave, we talked about America versus China. Right? Donald Trump needs an enemy that helps him get elected. He's going to try very hard to make it the Democrats. He's also going to make it the Chinese. The Chinese are wanting to regain their status in the world. The Chinese are not likely to be meek in the way they do that. So I think we're going to find, if anything, the rhetoric from China and America is going to ratchet up. But as we've said before, China needs to trade more than they need anything else in the world. So in this case, I think we've got 3 to 6 months of interesting collywobbles, but I suspect we're going to see the market recover after the election period is over, if not before. Now, all of this is, of course, based on Gil's interpretation of the world, and mine is simply one view. I try to look at data, I try to look at history. I think it's the best indicator. It's certainly not great to look at what Channel 9 or Channel 7 are trying to tell you, because all they want to do is scare you. So just a quick reminder, all politics is domestic. Everything the politicians say is about being re-elected or about maintaining your position of authority. Sitting leaders such as Trump, Xi Jinping, ScoMo, Daniel Andrews, all of these people want to create controversy, want to polarize views. They don't want everyone to be nicely cooperating. They want everybody to be fighting, because that tends to drive people to their side or the other side. So in summary, guys, I think we're finding it, we're in a time where we're going to see some volatility. The market is clearly wanting to recover. It should, because the amount of money the governments are spending is very positive. The amount of money that companies are intending to spend is very positive. And the reason that is because money is very cheap for them right now. So you're going to see a lot of infrastructure spend from governments all over the world, but also from business all over the world, because it's pretty uniform that corporate world is actually in a positive mindset here. And it's good for their balance sheet that the cost of debt is quite low. So on that, I wish you well. We'll talk to you in a month's time. Again, thank you, Paul, for speaking with us today. It's a pleasure to have you on board. As always, please Get in touch with us if you've got any questions or you want an expansion on what we've covered today. Until then, take care. God bless. I hope you and your families remain safe. Bye now.